All right, so in today's video, I am here to debunk the crypto Twitter noise. There is far too much opinion on the platforms right now talking about rate cuts upcoming, arguments around are rate cuts bearish for markets, are rate cuts bullish for markets, people making such certain calls, and really not backing it up with a whole lot of good quality data. And second to that, not backing it up with good quality long form research where you really go in and you try to compare the current environment that we're in right now with prior times in history where we've been facing a rate cut and try to see where that lines up the best that they possibly can. I'm just not seeing those kinds of takes right now online. And I just recently finished a live call for BNB members yesterday, breaking down my thoughts on rate cuts coming up. And, less importantly than my thoughts, my research and what the data tells us will happen. And in today's video, I'm going to share some of that research with you guys. But before we get into the research, I want to give you the current vibe check on crypto Twitter, the current sentiment around rate cuts according to crypto Twitter. People saying, warning, the higher the market pushes prior to the rate cuts, the worse the sell-off will be after the cut, cutting rates into a slowing economy with the market at all-time highs. Enjoy the pre-cut rally while it lasts because it will end in tears for retail investors. Then people saying here, bad news is finally becoming bearish as the market comes to terms with the fact that rate cuts are not going to fix this mess. What does that have to do with the market selling off a little bit on September 5th? I have no idea. Unpopular opinion, rate cuts are bearish. Okay, nothing to back that up. Rate cuts have been bearish in the past. Cherry picking 2 times a cutting cycle started at the beginning of a recession and then seeing the recession play out and the cuts pull the markets lower. Okay, given the history on recent rate cuts, what do you think the odds are? The cuts will be bearish within a short period. The past few instances weren't great. Okay, again, thinking about the wrong thing here. The market is extremely bearish. Yields crashed. Blah, blah, blah. The only ones believing in a positive effect of the rate cuts are retails. The Fed is cutting, but markets don't believe it will fix anything. Big players are rushing into yields. Okay. I don't know who this Dr. Profit guy is, to be honest. I don't really get into the whole crypto Twitter thing with these guys and try to, interact and be part of these circles because I don't really care. I think a lot of them, spell out a lot of BS online. But this guy's saying rushing into yields. You don't rush into yields. When bonds are being sold off, yields go up to accommodate the sell-off, right? This guy is saying here, the Fed cuts short rates, but long-term borrowing is getting more expensive. He's also saying, where was the worst part of this? Yields crash before the Fed cut, markets rush into bonds, effect is bullish. Okay. I don't understand necessarily where he's trying to make an argument here. The best part about this one for me is his take on 2025. Yields are rising plus 5% into the next cut. Investors are dumping bonds, demanding higher payback to lend money. If you look at the bond market right now, yields have been falling off a cliff. Okay, on the 10-year, and the 10-year bond has been increasing in value. So again, there's just so many bad takes right now online about rate cuts and what they're going to mean for the markets that I couldn't help myself but to post this video for you guys because I don't want you to get stuck on the wrong side of the trade by not having access to the right information to make good quality decisions in this market. So according to the data, if you want to analyze rate cuts through history, and that's what we're going to talk about right now, the relationship between Fed rate cuts and stock market performance is very context dependent. That's what you have to understand. You have to look at the actual economic backdrop that we're going into, that we're currently experiencing going into rate cuts to be able to determine how the market is going to digest those cuts. Now, there is a large contrast if you look back at history and you look at the data between rate cuts during healthy economic conditions versus those that were happening on the precipice of a recession or during a recession, right? Non-recession rate cuts have historically been bullish for markets, while recession-related cuts have typically been bearish. All right, so this is like a 30,000-foot view as to how to approach the phenomenon of rate cuts in the markets against performance in the S&P 500 at least. Now, the data shows markets gain an average of 20% in the 12 months following non-recession cuts compared to an average 16% decline when cuts occurred during or before recession. So This is some research that I included in a live call for BNB members, and this was the next slide that we went over. So looking at rate cuts through history, right? Now, we have to talk about the different kinds of rate cuts, first of all. There's a few different types. You have normalization cuts, you have panic cuts, and you have recession cuts. Within normalization cuts, you have insurance cuts, and I'll talk about all those things over the course of this video. But first of all, starting with normalization cuts, these are mid-cycle adjustments. This is when we're already in an easing cycle, and markets at this point have historically produced strong returns after seeing normalization cuts or just continuation cuts, let's say, in an easing cycle. We saw this in the 80s, we saw this in the mid 90s, we even saw this as recently as 2019, and we averaged about 15% in the S&P 500 in the following 12 months after seeing these normalization cuts. Then we have panic cuts, which we saw in the 1980s, late 80s, late 90s, 2020. And these are emergency cuts in response to financial crises. So the biggest thing to understand is that normalization cuts are planned as part of moves in monetary policy. Panic cuts are not planned. So the immediate short-term effect of panic cuts is not happening because the market's experiencing rate cuts. It's happening because there's external threats to markets. There's black swan events, particularly, let's say COVID, for example, in 2020. You know, you can go back and you can name all of these events that happened through history where there was panic cuts enacted. In the short term, markets reacted negatively to what was happening globally, but oftentimes what you see right afterwards is strong performance after markets recover from massively oversold conditions, and oftentimes we see a fair degree of easing coincide with these cuts as well. Then we have the cuts that everybody focuses on and that's worried about, which is the recessionary cuts, right? 1973, 1974, 1981, 2001, 2007. Most notably, people focus on 2001, 2007, dot-com bubble, great financial crisis. Now, these are where we're seeing rate cuts into a weakening economy, like a dramatically weakening economy. These are before recessions. They are the rate cuts that have consistently produced negative market returns, right? Monetary policy in this case proves to be insufficient to offset the fundamental economic deterioration that's happening. Now, if we want to look at the most recent rate cuts that we've seen, right? 2019, 2020, big cuts that we've experienced, right? We saw in 2019, there were normalization cuts, right? In 2020, we had an emergency cut. If we go back and look at the 2019 insurance cut specifically, it produced a plus 10% gain over 12 months. And that represented successful normalization that extended the economic cycle. So in this case, economy is moving along, right? Fed decides to lower rates to keep things moving, successfully done so. S&P 500 continues to grow. Now, if we look at 2020, for example, we saw emergency cuts. We saw panic cuts in this case, where markets plunged, again, not because of the rate cuts. The rate cuts were there to accommodate trying to make monetary policy in a position where we could actually recover from the crisis that we were facing. And then fiscal stimulus stepped in, and then both of those factors together allowed markets to drive up higher. So the thing that you want to focus on is recessionary cuts are actually bullish if you have anything longer than about a 3-month time horizon during that period. Normalization cuts are bullish in general. We don't really see markets break down during those normalization or insurance cuts, which we'll talk about in a second. But recession cuts are the biggest concern when it comes to markets actually heading dramatically lower. And this is where people start to get scared of the whole rate cut narrative, right? This is where people start to freak out and they go, oh my God, rate cuts are going to be bad for markets, is because they're comparing to these scenarios here. Now, I did a bit of research and I have an AI model that I built to help me gather all of my favorite macro data to look at. And I use that model with a couple of prompts that I've developed to give me this particular output when it comes to rate cut data, to give me a specific outline as to where we think we are right now in the economic cycle and where are we most closely aligned to in previous history with the current rate cuts that we're facing, right? I wanted a data-only answer. Because in this case, it doesn't matter what I feel about the market or what you feel about the market or what anyone on the Twitter feels about the market or rate cuts. None of that is relevant. We want to look at the data, okay? And so far, the data is telling us that the primary parallel we can draw to the current market conditions that we're in right now is 2019. Insurance style cuts, normalization cuts, right? In this case, the model is saying 80% similarity. Both feature external policy risks, softening, economic softening, but stable economy. Fed cutting despite low unemployment, elevated market valuations when cuts began. All right, so it's saying this is the most similar scenario we can put ourselves towards in terms of where we're going to see rate cuts right now aligning with. So again, in this case, these would be bullish rate cuts where we would see the market continuing higher over the future, right? Over the following 12 months post-cut. The secondary parallel is 1995, where we saw some normalization cuts, which are similar to insurance cuts, right? They're just cuts that are moving us in the direction of the overall monetary policy trend. 75% similarity. Both involve Fed acting preemptively to extend economic expansion rather than rescue a failing economy with strong underlying fundamentals, right? So we have a very similar setup, right? We are trying to extend economic expansion. We do not have a failing economy. GDP is growing, right? PMIs are improving. All of these things that we look at are actually improving, and I'm going to go over them with you in a second. Now, what it says for current unique conditions is that we have GDP growing at 3.3%, again, stronger than expected. We have unemployment rising to 4.3%, which is higher than it's been in recent history, but it's not at highs historically. Historically, this is low unemployment. Core inflation above target. And then we have the S&P 500 PE multiple trading at 23 to 28 times the historical average, where we're seeing 16 to 18x usually. Okay, so we're 23 to 28 times higher market valuation than what we've seen throughout history. But again, we're in a bull market right now, right? We're in a post 2020 era of fiscal expansion where we have a bigger balance sheet, we have more debt, we have more money printing. And all of this stuff needs to be factored in when you're looking at rate cuts. So the key differentiators that are also important to note is that we have higher inflation as a baseline. We're hanging out about 3% instead of 2%. We have elevated market valuations like we just talked about. And then we have the stagflation risk that's not been present in previous cutting environments. So where growth is not humming along as fast as it usually would, and inflation is a little bit higher than it was most of the time. But again, according to this model and the deep research that it did in this case to go through, and this is like 10 minutes of reasoning with multiple prompts, it says, if the 2019 parallel holds, expect 10 to 15% returns over the next 12 months. If 1995 elements dominate, 15 to 20% returns. If recession materializes, negative returns like 2001, 2007. Now, the most important thing to get out of this, the critical outcome determinant of this particular piece of analysis is whether rate cuts successfully extend the economic expansion, which is the bullish scenario. Again, so for the economy is expanding, which it is right now, and rate cuts continue to help the economy expand, then that's a bullish scenario for the markets. But if it proves to be insufficient against deeper economic weakness, so let's say the labor market scenario is worse than we can see in the moment right now, and it gets worse over time, then potentially that combined with higher inflation could create risks that we haven't seen previously, and then we could have bearish outcomes, right? So just out of curiosity, I had prompted this system that I built to pull all this research for me and lay this out in the most simplified of manners. I went over to ChatGPT 5 Pro, and I gave it a similar but very basic prompt. What is this 2025 September current economy, which is facing a likely rate cut next week, most similar to in other periods of history where we had rate cuts? Consider economic data, market sentiment, and market valuations. And then we had about 9 minutes of reasoning here. And again, what did it say? The closest historical parallel is 2019's mid-cycle adjustment, an insurance-style cut with growth still positive and stocks near highs. But today's setup has two important twists. Inflation is higher and valuations are a bit richer, closer to late cycle extremes. If you want one label, it's 2019 with a 1999-style valuation overlay and a whiff of 1995 soft landing on the inflation side, right? So it did mention 2019, and it mentioned 1995 in this case, right? So you can see, why does the 2019 mid-cycle adjustment fit this scenario closest overall? Well, the Fed eased despite ongoing expansion, citing downside risks, then trade war, now tariff, similar things. Stocks were at near highs in both periods. And the key difference is inflation now is higher and valuations are higher as well, and labor is softer. Then it's saying 1995, soft landing insurance cuts. It's closest on the inflation dynamics that we were seeing. Then 1998, insurance cuts. What it's saying is that the least similar period, at least for now, is the 2001, 2007, 2008 recessionary easing cycles that we went through. Those cycles began as unemployment rose and earnings and credit cracked. Today you have a softening labor market, but still solid earnings trends and no broad credit event so far. Forward PE is elevated, but Q2 beat rates were strong. Again, we had good earnings in Q2. We saw the data over the summer. So the economy is chugging along. We have the PMIs trending higher. And what you can see when it comes to economic trends is that the PMIs have been moving sideways pretty much all year, but in recent months, been doing better, right? Manufacturing, services, been doing better pretty much all year, right? You have consumer spending, which has been hovering around similar levels all year, nothing crazy. Consumer confidence, which started lower in March, got lower in April, is now back up at 98.7, right? We have consumer sentiment getting basically moving sideways for the whole year. I argue you could say it's in a higher position than it was in the spring. You have wage growth stabilizing. You have a personal savings rate that's humming along as well. You have real GDP that's above expectations that was revised higher. You have final sales to private domestic purchasers, which was revised higher to 1.9% from 1.2%. So again, you have the economy sitting in a strong position right now. And then you have people arguing about whether rate cuts are going to be bullish or bearish on Twitter, not understanding the dynamics of comparing where we are right now to where we've been in the past when we've seen rate cuts, and then from that point forward, trying to determine where we should end up. All right. So it says here, least similar for now, 2001, 2007 recessionary easings. The bottom line is that the most similar period was the 2019 mid-cycle adjustment, right? Key swing variables, unemployment trend, core inflation, earnings breadth, growth momentum, right? Overall, it's saying we should not be anticipating market downside with these rate cuts because we're cutting into a strengthening economy. And that is the truth, right? Where the labor market is deteriorating, all the other factors are improving. So it's not like it's all moving down together in tandem. Now, there's a very, very, very key secondary component to this, which is the strength of the US dollar. And if you've been following my work, you know that looking at global liquidity very closely is an important part of my strategy for determining, how much more upside we have in the markets before the trends could start to flip the other direction. And what we can see by studying global liquidity is that it has an inverse relationship with the US dollar. Okay, US dollar is growing, global liquidity is contracting. US dollar is contracting, global liquidity is growing. All right, that is the relationship to understand. And so I asked it, now based on this research, did the US dollar strengthen or weaken after each of these cuts? And what can we expect throughout the rest of Q4? So, setup right now, markets expect the Fed to start cutting next week. ECB already cut, broad dollar already fell, blah, 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 blah. Bottom line, 1995 and 2019 insurance cuts, dollar strengthened into the quarter after the first cut. For September to December 2025, given an expected Fed-led easing cycle, less aggressive easing abroad, and potential BOJ hikes, and an already downtrending broad USD, the most likely course is a further modest broad dollar depreciation through Q4. Okay? That is what we're looking at, is that the dollar will likely continue to decline. Base case path for the next 1 to 3 months through Q4. The near-term setup looks a lot more like 1995 and 2019 on the announcement, where cuts alone didn't sink the dollar, but the relative cycle is different. The Fed is likely easing more than the ECB and the Bank of England, and the BOJ may hike, compressing differentials against the dollar. With the broad USD already trending lower this year, the balance of risks argues for additional gradual depreciation into Q4. Again, this is another positive sign for markets. When you have rate cuts, and you have a weakening dollar into a strengthening economy, you have rate cuts into a strengthening economy that global liquidity is being pushed up by. Again, global liquidity has been moving up to a new all-time high this week. All of these things are tailwinds for the markets, all right? Massive tailwinds for the markets. So I made a few videos earlier this month, and I'm just going to show them to you here, right? I made a few videos earlier this month talking about September and the data that I was looking at for September that determined, for me at least, why I didn't think this was going to be a very bearish month at all. And I posted these videos at the very beginning of the month. I think I posted this one just after September 1st, or maybe even on September 1st, stating, hey, everyone is wrong about September this year. It's not going to be that bearish. In fact, it could be quite bullish for the markets. And what I saw during this period of time that I posted these predictions was everybody saying the market is about to break down, blah, 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 all of these factors. And the problem is that everyone needs to stop fading macro. And most importantly, you guys that are watching this need to ignore the crypto-only analysts or gurus, mentors, whatever you want to call them, who only look at crypto and who only ever cite crypto-related historical trends and data and halving cycles and altcoin this and altcoin that. They don't know what they're talking about. Now, I don't want to name any names because I'm not here to bash people, but there are other people in this space who offer, similar products to myself in terms of masterminds and offering market research, etc. And I saw a few of them publicly post at the beginning of September saying, we just took profits in the group and we're going to wait to buy the dip in September. Join us and we're going to buy the dip in September when the markets crash and we see the rate cuts. And I was like, oh, this is so bad. These are people that are not looking at macro when the macro data is telling us why this month should be strong and why the rest of the year is going to be strong, most likely. You do not want to be shoring up your portfolio into cash right before we get into Q4 on the precipice of a rate cutting cycle into the backdrop of a strong economy. You don't want to be doing that, right? And I made that point in this video talking about, what I saw as all the bullish factors being for September. And people are fading, right? People are freaking out on Twitter, and you had a bunch of people bear posting this one analyst saying, or I guess crypto, I don't know who Don Alt is. I don't like people who don't show their face, but a bunch of people I saw post about at the end of the cycle last week are now bull posting while nothing has changed in that time. Just get some help. Now that's true. I'm not saying I endorse this person's opinions or statements on the market, but this is correct. Nothing has changed in that time. Nothing changed in the period of August to September that should have had people bearish on the markets. Okay? Global liquidity has been trending up. The US dollar has not reestablished a meaningful uptrend at all. In fact, it's been moving sideways and lower the entire time. You have adoption continuing to move in the right direction for crypto. You have regulation moving in the right direction for crypto. And you have factors setting up for a continued inflationary environment where risk assets like equities, crypto, gold should all do much better as we continue in this fiscal dominance regime that we're in right now, where the government wants to run a hotter economy, a bigger deficit, and they want to do so on lower interest rates, which will most likely stimulate the economy. So anyone that you saw saying September is going to be red, right? Sell all your crypto this month before the rate cut crash, or take profits now and reallocate later after the rate cuts. What are you doing? Because when we were saying this, and I'm just looking over at my other monitor here that has the price of Bitcoin on it, when you were saying this at the beginning of September, Bitcoin was at the bottom at 107K, and now we're all the way back up at 115 as of today, and we're September 12th. So if the market doesn't give you a pullback back to those levels, and some people took profits right before September, they probably would have taken profits still lower than these levels on the way down. They probably started to get scared as we broke below the 50-day moving average and moved lower very fast. Again, classic shakeout. They're probably going to be buying into their positions higher. You know what's higher today? Solana is higher than the beginning of the month. Ethereum is higher than the beginning of the month, right? All of these coins are higher than the beginning of the month. So if you sold your portfolio to buy back lower, I think you made a mistake so far unless you get the entry that you want. Right? I'm not saying that we can't have a pullback next week or around rate cuts or after rate cuts or in October. I'm not saying we can't retest the lows of 107K, and I'm not even saying that the whole trend can't fall apart altogether. But what I am saying is that people who were bearish on September, I do believe to be in the wrong camp, and they were not looking at the right macro data. And you cannot, as an investor, you specifically cannot fade macro data anymore. You cannot. It is everything in these markets, right? And you must fade people who don't look at macro. They simply don't get it. If they don't look at macro and they only look at crypto-specific information and data, then I don't know what to tell you. I don't honestly think they have the best grasp on the markets, and I don't think they should be listened to for you to make informed decisions about what you should do with your portfolio. I'm not saying I'm perfect at all. That's not what I'm here to do and tell you that I'm, the best in the macro space when it comes to crypto. I have been very correct in my calls for a number of months in a row in terms of how I see the market playing out here. I did call for a bullish summer. I did call for a bullish continuation. I did call for Ethereum being the only altcoin to hold in the portfolio versus everything else. That's starting to change now. Hint, hint. But other than that, I don't see many people, in the crypto space that have been as accurate as I have recently about calling where the market should go. And it's not about calling. It's not about making predictions. It's about looking at the data and going, okay, well, what does the data tell me should happen in the market, right? How can we compare this to historicals? What are the things that actually drive the market? What are the flows telling us? What are the flows of capital telling us? And they've been telling me for a number of months now that the market is setting up for a continued rally, and that's what we've been seeing. So I would stop fading macro, guys, and I would start studying up on this a lot more than you may have already been doing. So that's my conclusion on this topic. I don't think rate cuts are going to be bearish. If we go back to the beginning here, I think all these people have a wrong take on the market. I think you need to look at the data. I think you need to even go and ask ChatGPT if you want to be lazy. And it's funny how it gave me the exact same answer as I spent, multiple hours prompting my other system to help me figure out and get to the bottom of, right? These tools are getting good these days, guys. And, I don't want you to be sitting here listening to people who use outdated analysis frameworks for looking at these markets. So if you're looking for more, please do subscribe to the channel. I'm going to be posting a lot more. And in fact, I'm actually hosting a live masterclass at the end of this month on September 28th. You can pull up your phone and scan this QR code to register for the masterclass on September 28th. It's going to be a live investor workshop hosted by myself, where I'm going to teach you how these macro frameworks work in about a 90-minute, live lesson. And if you'd rather, skip all of the research and get straight to the front of the line when it comes to getting the best information in financial markets about how to position yourself for specifically your crypto investments, then I encourage you to apply for Bull Market Blueprint. You must have $50,000 or more in your portfolio to submit an application. And then from that point forward, I will review it and we'll see if we can help you inside of Bull Market Blueprint. We have dozens of 5-star Trustpilot reviews. We don't have anything other than 5-star Trustpilot reviews. So I will leave you with that today. Live masterclass is coming at the end of the month, right? I would love to see a lot of you guys there. We're going to pack it out. We're going to fill it to as many people as Zoom will let us have. I think it'll be about 500 from what I can see. So make sure to register now so you actually get one of those spots, because there will definitely be more than 500 people trying to register for this after the amount of accuracy of my calls over the past couple of months, even since I just started this YouTube channel posting this data. But that's it for today's video. For me, guys, I welcome you to the masterclass at the end of the month. And of course, if you'd rather cut straight to what matters and have an inside view as to what I'm investing in my portfolio and how I view the markets every single day, you can apply for Bull Market Blueprint. And I'll see you in the next one. Cheers.